All right, so before we get into creating the data tables, so in the last video I talked about the different models for creating value, the dividend discount model, the capitalized earnings model, H model. I showed you how to value Walmart, so you'll value your firm. So before I get into doing the sensitivity analysis that I finished up on that last video, I want to talk about a couple other models. The first one is the H model. The H model is primarily for fast-growing companies, maybe a tech company. It could be for an unusually slow-growing company, and so they're having a period of negative growth, then get back to normal. But you're looking for a firm that either has abnormally high growth for a short period of time, followed by stable growth, or unusually low growth for a period of time, followed by normal growth. What we call, I say stable growth. The term I like to use is terminal growth, that growth when they become a normal company again. So the long-term stable terminal growth, usually for that I'm going to use some proxy of the U.S. economy. So you remember we've talked about productivity plus labor growth plus inflation. So we'll keep using those as our measure of how fast the economy grows, somewhere between 4 to 6% on a nominal basis. So we're including inflation. So some firms, I'm not saying if I think the economy is growing at 5%, I'm going to use 5% for the terminal growth for every company. I do think there's companies that will grow more slowly than the economy, especially those that are globally saturated, and really their only growth is going to be population plus inflation growth. So there's just not much more productivity in some of these businesses. So you have to kind of think about the business. But long-term growth, so when you do this in the actual paper, you'll come back to your long-term growth assumption and talk about your company, its industry, and do you think this is an above average, below average industry over the long term, given the products that it produces. But then you get the short-term growth, and we talked about the short-term growth already. Remember we talked about the PEG ratio approach, the sustainable earnings, looking at history. So we did all of that. So the short-term growth, that's a tough number to get, especially the timing, how long will it last? But that gives us the H model, and as we said, the H model looks just like the dividend discount model if you take this middle section out. And so this middle section is that extra value going to the firm due to the short-term growth. It could add 10, 20, 30, 40% to the growth, depends on the company. With a firm like a Google or an Amazon or Facebook, that can be a pretty significant part of the value of the firm. So it's essentially the Gordon growth model or the dividend discount model plus that higher growth period. And then the H in this model is how long will it take you to get from the short-term growth to long-term. So you're going to start short-term growth, and it's going to slowly over time come down to long-term growth. But how long is that period? The H is that half-life, that midpoint. So let's say you expect growth next year to be 10%, but the terminal growth is going to be 5.5%, and you think it'd take 8 years to get from the 10% to the 5.5%, then your H is 4, which is 8 years divided by 2. This is the hardest thing on paper 4 to come up with, is what is your H going to be? And it's very subjective. You have to have some rationale, so it's creative writing time. Find some way to justify, but it needs to be rational. What do you think about this industry? You'll see, you saw with Walmart, I didn't have it as too long of a period. I gave them a few years of extra growth just because of COVID-19 and pandemic, coming out of slow economic growth. They're the place people go to. But long term, Walmart, yeah, I don't see them having a lot of hyper growth. They can't build too many more stores in the U.S. Their expansion overseas is somewhat limited. So you have to pick a number and rationalize it somehow. I'm not asking you to go out and do massive research to figure out that number, but you should have some basis, some rationale for the number. So there's the H model. We've already seen it in a previous video. The next one is what I call a proprietary growth model. And here, essentially I'm using the H model, but for a company that pays no dividends. And so the theory here is the firm's not paying dividends because they're growing fast. So they're reinvesting everything back into the firm. They're not going to pay any dividends. And I'm going to assume that's going to continue until they get to that long-term terminal growth. When they get to that long-term terminal growth, that's when they'll start paying dividends. So let me give you an example here. See, here I have Google. Their earnings per share last reported was $45.49. I got that from Yahoo Finance. It's a fast-growing company. They've got a lot of projects going on. It's a huge company, so growing really fast is getting tougher and tougher. But let's assume, okay, they can keep this higher growth going. It'll take 20 years to get from the high growth to normal growth. Right now, they're growing really fast, so I'm going to let them keep growing at 25%. It's pretty amazing. Google's still making headways. Essentially what Google's doing, along with Facebook, is taking all the advertising dollars around the world, and they're just getting a bigger market share. It's not that the ad dollars are growing significantly, but it's that their share of the ad dollars keeps growing and growing. You almost have no choice but to advertise with Google. And they've got a really good algorithm. It's a really good product. You get what you pay for, so that's pretty cool. So I'm going to say 25%, and I'm going to say their ultimate long-term growth is 6%. That's somewhat on the upper end of what I think economic growth will be, but it is Google, and they've shown themselves to be innovative, so I'll give them a little benefit there. I'm going to use a beta of 1.35, and so that gives me a discount rate of 9.6%. And then this is the one other assumption, is once they get to that 6% growth, how much will they pay out in dividends? How much of their earnings? And a typical company, especially a mature company, pays 40–50% of their earnings out in dividends, so I'm going to use 40%. There's a lot of math we could do to come up with that 40% and its implications for the long-term growth, but I'm just going to keep it basic here. And so what you'll notice is you'll see their earnings growing really fast, but each year the growth rate declines a little bit, because that's my assumption here. And it comes down until it hits 6%. When the growth rate hits 6%, they start paying dividends. And then I have a discounted cash flow. And so when I take, so you look across the time, it's the year, it's the growth rate, earnings per share, payout ratio is 0 until they hit a 6% growth rate. Dividends are a 0 until they start paying out. There's the discount factor using 9.6%. And the discounted cash flow is when I sum up that column, I get a valuation of $15.40, and right now, if you go out to Yahoo Finance and look at Google, you can see that they're currently trading for, so Google or Alphabet is currently trading for 1621.01. So I think their stock looks a little expensive to me. But small changes in these assumptions make huge differences. I think the long-term growth is going to be 5%. That has a huge impact on their valuation. If I think it's only going to take 10 years, that has a huge impact on their valuation. I think their beta should be 1.2. That has a huge impact. So that's one of the downsides of valuing stocks, especially a stock like Google. Remember, Google's a growth stock, very, very sensitive to the discount rate, so very sensitive to interest rate, very sensitive to the growth assumptions, and small changes have huge impacts. So Google could be worth anywhere from $800 to $4,000, and it's currently trading for $16.21. Maybe that's on the lower end of the valuation, but really difficult firm to value. And you would see something like this in a data table trying to get multiple scenarios on this. There's just too many moving parts. There's the age, there's a long-term growth rate, the short-term growth rate, the beta. There's so many things in this assumption that you'd have to vary to figure out the valuation of Google. So you would get pretty wide ranges of valuation. So that's what I call a proprietary quantitative model. You should actually build something like this and actually call it proprietary quantitative model. That just sounds good in an interview. Proprietary just means that you built it. You're not buying it from somebody else. Quantitative just means you got at least one formula in it. Who knows what the word model means? Just means something in Excel or Python or somewhere that has formulas. The quantitative and the model kind of mean the same thing. But a proprietary quantitative valuation model is just, especially if you're talking to the human resources people and say, yeah, I built a proprietary quantitative valuation model for stocks. It just sounds impressive. And the model I just showed you is not a very complicated model. So it doesn't have to be all that complex. I think it gives you decent answers and decent numbers. What other models are there? Well, probably the most highly respected in academia are free cash flow models, which what that means is it's a lot like using the H model or the Gordon growth model, but instead of using dividends, we say, okay, the firm's paying dividends like a firm like Apple. Apple pays dividends, but they're not anywhere close to the true free cash flow that Apple's producing. And so if you use their dividends to value Apple, you're going to get a very low valuation. They're just not going to be valued correctly because their dividends are a small fraction of their true free cash flow. So instead what we do the free cash flow. We can do it to the firm or to equity. If we do it to the firm, then we value the firm using their cost of capital, not their cost of equity. But look, the formula looks very, very much the same as what we saw with the dividend discount model. And then once you get the value of the firm, you subtract out the value of the debt and you have the value of the firm to equity. Or you can just do free cash flow to equity. So what's the free cash flow of the firm after you take out the debt interest expense? And you value that using just like you would do it for the Gordon growth model. So if you'd like to do a firm that's not paying dividends for your papers 3 and 4, you can certainly do that, but you have to get a free cash flow per share from me, and I can show you how to do that. It's not that difficult to at least estimate a number. The downside of this model is it tends to give some really bizarre answers for a lot of companies. So it can be a little frustrating because you get answers that just don't make sense. The valuations are so significantly different. And it really comes down to free cash flow being a hard number to calculate with any precision because it's really a very subjective number. But free cash flow, what that means is the cash produced by the firm, which management has the freedom to do with as they like. They don't have to reinvest it into the firm just to maintain their current capacity. But they can pay dividends, they can buy back stock, they can pay down debt, they can expand the firm's capacity. That's a free cash flow. If you're building more stores and expanding overseas, you can acquire another firm, or you can just hold it in cash like Apple and Microsoft are doing, just holding the cash, waiting for some major opportunity to invest. The next model we'll definitely not use in this class is the contingent claims model. I've seen that in graduate level classes. I haven't seen it much in undergraduate. There's probably some undergraduate programs that cover it in a more advanced class. I don't cover it in my security analysis class. It's just unless someone has actually had an option pricing class, it's hard to do this in a class and not have it dominate the entire class. But essentially what it says, there's the value of the firm as is, but this firm has some options. There's some things that it could do, and if it did them and they turned out, it would be incredibly valuable to the firm. But if they did it and didn't turn out, they could shut it down. It wouldn't cost them much. It looks a lot like a call option. We'll talk about call options later. But there's a cost to experimenting on the option and see if it works. But you can shut it down and not lose that much money if it doesn't look good. But if it does look good, you can make a fortune. So it could be a pharmaceutical. Pharmaceuticals have their existing drugs, but you know they're going to develop a new drug, and it could be a major drug. If it doesn't, they don't find the drug, then that's just part of their normal operations, their R&D that you normally have in the valuation of the firm. But that next big blockbuster drug, that's going to add tremendous value, and that's not in the current cash flows or assets of the firm, but it's a potential. Or it could be an energy company that does exploration. They can drill and look for oil, and that costs them money. That's part of their normal operations. But if they find a major new site, boy, that's going to be huge. So these firms that have these options, it's not all firms. I don't think a Walmart has this. I'm not even sure some of the tech giants like Facebook have anything like this. What major, Facebook's trying some stuff like with currencies and other things, but or Bitcoins kind of things. But it's hard to think of them having some major option, some opportunity that, boy, if it turned out, it would be blockbuster, like a Disney with a new movie that just takes over, like a Toy Story that just makes them hundreds of millions, if not billions of dollars. Not that many firms have this type of valuation, but when you look at these firms, they tend to look expensive because if you only value what they're currently doing, you're missing the value of the option. It's very hard to do because you have to use option pricing models, which can be fairly complex. But if you're interested in that, there's a class I have, links to videos. Dr. Demadaran, he covers this in his graduate level class, and I've got the notes from the class. If you want to go through that section of his class, you can look through my notes and see exactly where he hits that. But just be aware, it's a fairly complex undertaking. Now, he does have online models he provides where you can actually get his Excel model and see how he sets it up. But getting some of the assumptions is a little bit difficult if you don't have some background in option pricing. The last set of models I don't use at all anymore. It's the multi-stage growth models. I had one professor require us to memorize this for an exam, which I thought was pretty ridiculous. He didn't tell us he was putting it on the exam. I figured it out based on something he said in class. I think I was the only one in the class that figured out he was going to put this on the exam. And I didn't tell the rest of the class because if I were wrong, I would have felt really guilty if they all memorized it and he didn't ask it. So I just kept it to myself. And so, boy, it was really frustrating because you can just look at it. It's not just that the formula is complicated, but it has a sum key in it, which means you got to do this over and over and over again for whatever, how many t's there are. You got to do this over and over again. You got to do this over and over again. So it's really tedious. But we have Excel now, so we don't need these formulas. You can set this up. Essentially what I just did with the H model and what I just did with my proprietary valuation model, quant model, is essentially doing these functions in Excel. If you ever have a professor require you to memorize one of these formulas, man, let me know and I'll see if I can talk them out of it, because it really doesn't make much sense to do that. Now we're going to move on to the sensitivity analysis. And so let's look at our assumptions for Walmart. So let's put them all back together in one place so we can somewhat understand where we're going to go with the sensitivity analysis. So we decided that our market risk premium and our risk-free rate, we've got those decided. So we decided the risk-free rate was, I think, 1.9%. So our risk-free rate is 1.9%. Let's just print it all down here. And we decided our market risk premium is 6.1%. And so those are the basic assumptions that we will not change. We'll use those for everybody. And then we said on beta, we have a base case. We wanted our base case to be 0.7. That makes a lot of sense for a firm like Walmart, 0.7. And we said our range would be a low to a high. So we said the range would be 0.5 to 0.9. So 0.5 would be the low, 0.9 would be the high. So there's our beta cases. And then let's look at long-term growth. And here we have a base case. So our base case for growth was 4%. So let's think about a range on that. Keep hitting the cap lock. So let's have a low of, boy, on this one, I don't know how low we go with Walmart. Let's say 1%. And a high, boy, maybe, boy, we looked at the data before. Remember when we looked at their range of growth? So their 10-year was 3.48. 5-year is pretty strong, and the 3-year is pretty strong, but that's more of a short-term growth rate. This is a long-term growth rate. We can't definitely grow that fast. I think 5.5 is about the best we can go there. When you do your own company, obviously you can come with your own ranges. One thing to remember though is we'll get our discount rate. Our base case discount rate is the risk-free rate plus beta times the market risk premium, or 6.2%. And so with that 6.2, we don't want our highest growth rate be close to that number. We don't want to be like 6.1% or something. That's just too high. So we want to make sure we have a a range of growth that's going to be below our discount rates. Now we'll probably get in some problem here at the bottom, and you'll see. So what we're going to do down here is we're going to set up the base case. So we're going to do the dividend discount models. So remember that the dividend discount model is dividend 0 times 1 plus long-term growth divided by KE minus long-term growth. So we need to have dividend 0 so dividend 0, we got that early on somewhere. I have to go back and find it. Here it is. Dividend 0 is $2.15. So there's our dividend. So we're going to find a cell. I'm going to put it right here in C129 where we're going to put that formula. So equal dividend 0 times 1 plus our base case. We're doing everything base case, 4%, divided by, so our KE is going to be our risk-free rate plus beta times the market risk premium minus our long-term growth. And we do that, we get 103.04. Remember our previous model is 101, and the reason it is because we use 6.2 as our discount rate. We rounded it. If we hadn't have rounded it, we would get the same answer. So I can just show you here. If we hadn't rounded, we get 103.04, 103.04. So remember, we rounded our discount rate. So you might not want to round your discount rate. I'm going to leave it. I'm going to go ahead and leave it here just so I know my base case matches the number I got. So there's a good reason not to round that discount rate. So 103.04. So now what we're going to do is we're going to look at our betas. So we're going to do our range around betas. Here you want to make sure you start with the highest number and go down to the lowest. So we'll start at 0.9 and we'll go down to 0.5. So there's our betas. And here we want to do our growth rate. So we'll start at our low, 1%. And we'll raise that 0.5% all the way up to our high, which is 5.5%. And then what we're going to do is we're going to change these numbers so that we can run scenarios. So what you want to do is you want to highlight this entire area and then do data, what if analysis, data tables. So data, what if analysis, data table. And your input cell is your beta, so your base case beta is there. So your row input, because we have beta across the row, so we want to say that that's 0.7. Instead of all of these numbers, it's going to be 0.7. And then our column input is the growth, so we go to our base case growth right there. So you reference for your row input, you reference your beta. For your column input, you reference your base case growth, and you say OK. And we'll give you a bunch of data, so we're going to convert that to commas. Now I'm going to clean it up here and just make it look pretty good. So we're going to change that to blue. Just make it look good because you're going to put it in your paper. And here's our growth numbers. And what I like to do on here, so let's just find that base case. And here it is right here. 4% growth, 0.7 beta, 103.04. So that looks good. So we don't really need this number. What we want to do is we can just hide it by just making the cell and the text the same color. So that doesn't show up. So now we got all these prices. Now what do we want to do? Well, let's go get the current price for Walmart. And so we can see the current price of Walmart is $137.98. $137.98. So we'll put the current price in there. And so now what do you want to do? Well, here's our valuations. So there's a few things we want to do here. First of all, if we have a negative number, that doesn't work. What that means is our discount rate is lower than our growth rate when we get into low betas. And so the first thing we want to do is hide those. So what we're going to do is we're going to click on this and we're going to go to conditional formatting. So for the times when the stock price is greater than the current value, when it's greater than this, we want to make it green with green text because that's good. So like here, we think the stock's worth 143.11. It's trading for 137. So that's good. We like that. So we'll say OK. We'll do another conditional formatting when it's less than the current price. That's when we want red. And then the last one we want to do conditional formatting. If it's less than 0, here we want to do a custom format where we want to use a fill that is black. We just want to completely black it out. And let me change that. You want a fill that is black, and we want the text to be black. So you just want to black those out. So it didn't do it. So our font is black, and our fill is black. We say OK, and that gets rid of those. So those that are negative don't make sense. And so here we have a chart for Walmart. Now what you want to do is say, well, where's my kind of my normal range? So 0.7 is it, and maybe I think 3.5 to 4. So I think this is probably my best area. Maybe it's a little higher than that. Maybe I'll go like this, or maybe I'll go like this. So I'll do a thick border. Maybe I'll bold those. So maybe this is really where I think my valuation is, but I got full valuations. Here I'm going to work based on this. I'm going to recommend avoid or sell Walmart as valuation as it appears overvalued. Because you can look and tell from the chart that in my main area that I think the valuation is, they're only cheap in one cell. That's with a beta as low as 0.65 and growth of 4.5%. But most of the table is pink and doesn't really doesn't tell you the story for you know, a strong story for Walmart. They could be worth as little as $50, $60, $69, and they're trading for $137. Now, you might not like these rows, so you might say, "Hey, we need to, you're way too conservative." Make sure you check on the boxes. So you might make sure the column width is exactly the same all the way throughout. That was too much. So just make it look as professional as possible. And so yeah, even with the higher growth going up to 6.5, you can notice with the 6.5% growth, you have a lot more of these infinite values that just get kicked out. So here it's maybe a better case, but boy, you know, Walmart is struggling. I really have a hard time believing Walmart's going to have consistent 5.5% growth for the next 30, 40, 50, 60 years. That's much faster than the economy. You know, I think the economy is going to grow 4 to 5%. I just don't think Walmart is a firm that's going to grow faster than the economy. They're so saturated in the markets they're in. They're really struggling growing overseas. And there's some pretty hefty competition. Obviously, Amazon and Alibaba and firms that are just really good competitors. So I would probably recommend for this firm, avoid. So this is a chart you should put into your paper. It's a really good chart. What it does is it allows you to go beyond just one price. So up here you had one value for discount model, and then you had other valuations. And so yeah, that's fine. Overall, Walmart looked expensive on a dividend discount model, H model. They looked a little cheap on the capitalized earnings model. However, when I ran multiple scenarios on the dividend discount model, I got a valuation that made Walmart look pretty expensive.